Hi there, I'm Seb Maley from Qdos, and in this video we'll be looking away from IR35 but at another piece of tax legislation targeting contractors, which has reared its head in the last few weeks. The Managed Service Company, or MSC legislation, was originally introduced 15 years ago in April 2007. The rules were a reaction by the government to what they felt was widespread tax avoidance involving providers of accountancy solutions to contractors. Prior to April 2007, there were a number of very large providers who essentially offered off-the-shelf limited companies to contractors with a standardised or even commoditised service, which in HMRC's eyes meant that the contractor themselves was not legitimately running a business. HMRC's view was that if the contractor was benefiting in this way, they shouldn't benefit from the tax advantages of being in business on their own account, and that their earnings should be taxed as employment income. In that sense, the tax risk is very similar to IR35, but the legislation is even less clear and definitely less well known. Back in 2007, the variance in tax between employment and self-employment was much greater, whereas now the biggest chunk of differential would be the employer's national insurance, which a contractor would have to pay if they were found to be caught by the MSC rules. The legislation was written in such a way that made it very difficult for these large providers to avoid it, and it also carried fairly aggressive debt transfer rules. This meant that if a contractor couldn't pay, the debt would move to the provider, directors of the provider, and then up to others in the contractual chain like recruitment agencies. All of this meant that the market changed significantly ahead of the new rules coming in, with providers completely altering the way in which they worked to ensure that they wouldn't fall foul of the rules. For a long time, it felt like HMRC considered that to be job done, and the legislation essentially operated as a preventative measure without the need for them to actively police it or target contractors or providers. However, in 2016, we had the first instance of the MSC rules being heard in court in a case involving a firm called Costello Business Services. Costello were a provider of accountancy services to contractors working mainly in healthcare, and HMRC's view was that they were actually a managed service company provider, and that they were involved, which is a key word with MSC, in the running of their clients' businesses. The first tier tribunal agreed with that view. It was then appealed to the upper tribunal, who also agreed before finally being heard at the Court of Appeal in 2019. They also sided with HMRC, which meant that the contractors involved were ultimately hit with significant tax bills. Because Costello provided the same service to all of their customers, it meant that HMRC could pursue every single worker that they engaged, leaving a total bill in the several millions of pounds. Costello did seem like a bit of an extreme case, and the evidence suggested that they were going a lot further than a typical accountant, even one which specialises in services to contractors. But HMRC clearly gained confidence from the result, and very soon after we saw letters being sent to contractors who had used other firms, advising them that HMRC were opening an inquiry. Perhaps because of COVID, things then went quiet for a period, but in the last few weeks we've seen HMRC pick things back up in an aggressive way. They have now issued letters carrying a tax bill to over 1,000 contractors who had used a particular accountancy firm. The bill has been issued because HMRC have a limited window of opportunity to retrospectively issue tax determinations, and the 2017 to 18 tax year was about to close. But it's clear that HMRC feel that they have a strong case, and it will come as a major concern, obviously to those who are directly affected, but also to the wider contractor community. The MSC rules are not widely understood, and naturally contractors will feel like they haven't done anything wrong in using an accountancy firm, but potentially have a substantial tax risk. It's likely that this case will also go to tribunal, where the evidence will be heard by a judge, so things may progress fairly slowly from here. We will keep you fully updated in this and any other MSC cases that come to our attention, but it's certainly an issue to keep a watchful eye on. You can find more information about the MSC rules on our website. Please subscribe to our channel for more regular video updates. Thanks for watching, and we'll see you next time.